Good morning and welcome to the Killik & Go podcast for Friday the 16th of October. We've had a week of stabilisation for markets. So we've had a couple of bits of data from the US, the CPI number, inflation number that was above expectations yesterday, and a good jobless claims number. We've also seen on the other side of that continuing evidence that the Fed remain pretty dovish towards interest rates, so less likely to be increasing rates. So that sort of recovery in the growth prospects of the economy, or stabilisation in the economy with continued very easy monetary policy, has been good for markets, and you can see that we've had a good rally into the end of the week. That's also been helped by a little bit more visibility about company earnings. So generally so far, businesses have made their guidance, so we were sort of fairly confident about the achievability of earnings because of the downgrades have been pretty aggressive into this Q3 results season, and that sort of started to come through. What we were worried about was the guidance for 2016, whether management teams would take this opportunity to downgrade their guidance more aggressively because of the volatility that we've seen. That hasn't really taken place so far. We're still very early into the results season, but the banks, which have been the main sector to report, have avoided doing that in any large scale. So far, in terms of aggregate, the bank sector has made their numbers, the lowered guidance. They continue to grow their book value, as this chart shows. Particularly interesting was probably the Goldman Sachs numbers. They missed their numbers, but the stock was up, so the market was willing to look through that variability in the more cyclical aspects of their business, which are the fixed income, currency and commodity parts of the business, and concentrate on the growth that they're seeing in the M&A side of the business, which is why we like the stock. So we remain positive about banks as a way of getting the sort of lower PE, bigger value, less volatile stocks into the portfolio, with the sort of increasing payaways in terms of dividends going into the next few years. Our weighting towards that sector is probably higher than it might have been because we got slightly more concerned about the healthcare sector, particularly since Hillary Clinton's comments on price gouging that came through towards the end of September. So if we go back to Bill Clinton's health reform package, we saw quite an extended period of underperformance in pharmaceuticals in the 1990s on concern about pricing. And that's what's starting to feed into that sector again. And you can see the underperformance in the healthcare sector against the market since those comments around that time in September 21st. We said last week that we feel that the emerging market stocks can lead this rally because that's been in the eye of the storm. That's been perceived to be a problem. And if we see Chinese data starting to improve towards the year end, they will benefit disproportionately. I do think it's important that we've seen further evidence this week that you've got to pick your stocks pretty carefully. So Burberry came out with their numbers this week. They were guiding towards mid-single-digit like-for-like growth, and they came in with a 4% like-for-like decline, so very big miss. And here you can see Burberry was trading in line with the emerging market index, but came off fairly broadly, aggressively on the back of those numbers. Looking into next week, again, it's very busy. We've got, of the Killik stocks, we've got Intercontinental Hotels, which is one of those sort of emerging market-facing stocks that we do think will continue to make their numbers. We've got Verizon, which now got a sell-on, preferred Deutsche Telekom in that space, so it'll be interesting to see whether they're continuing to have to spend more to retain their customers. We've got Harley-Davidson, we've got SAP, where we feel their numbers will be pretty solid. We've also got EMC, Boeing, eBay on Wednesday. I'll talk about Boeing a little bit more in due course. Thursday, GKN, Travis Perkins. Travis Perkins we'll be looking at closely because we saw some slightly negative commentary on the UK from the Wolseley numbers. Microsoft, Amazon and Alphabet, that's obviously new Google and Union Pacific. So the key bellwethers for the tech and the growth stocks within so probably the global universe. Amazon and Google will be reporting on Thursday, so they'll be extremely important for market sentiment. Just going back to Boeing, just worth noting that the CEO of Delta Airlines this week warned that aircraft pricing was going to get quite considerably lower as a surplus of used jets comes off the leasing market and is available for purchase from the airlines. Just think it's worth noting that a lot of the new demand coming into aircraft orders is coming from the emerging markets. So we need to keep an eye on the durability of that demand and keep a close eye on the supply and demand equilibrium within the aircraft industry. So we'll find out a bit more about that on next week when Boeing report their numbers. Anyway, thanks for listening. Have a good weekend.